Good morning, 8:32 a.m. Pacific Standard Time, 10/14/2012. We're gathered here on this Sunday because we're gathered here to take a look at the weekly chart, and we're the weekly chart on this S&P 500 index. Do you remember that one up here? We traded up to our level 1475. We're on that 10-week moving average. We are going to have a bellwether of big multinationals. We're going to have lots of earnings starting this week, starting Monday, tomorrow, and the S&P is flirting with its 10-week moving average. And you can see the blue line here, how it likes to hold support and then rally up. Well, look at what we have here. Let's take a look at this whole thing here. Now, the S&P is going to be very volatile because of the quarterly earnings that we're going into the fourth quarter. We are at the 10-week moving average. I will tell everyone, once again, on the S&P 500, during this volatile earnings season, that we're going to be looking for the 20-week moving average. That's at about 1391 on that S&P. If we break below some of the key levels that I had talked about, which was right here, 1425, we came down here. Let's take a look. Let's just draw this 1424.79. That's right here at the top of that weekly resistance. It's slightly above this half weekly breakout bar. That area right here, we trade down tomorrow. We're going to look and see if we can come right down here to 1408, 1410 on the S&P really, is going to be the key area of this overall weekly cycle of trade management in here. And yes, we hit that wall of resistance. And we're going to pull back in this bull run. This S&P has been on fire. The index has been on fire. And one of the things that we're going to be taking a look at during the earnings season is that most mutual fund managers, hedge fund managers, have underperformed the market all year. Why? Because they don't believe in the economic cycle, and I don't believe in a lot of things. And it kept them on the sideline, and Bernanke will make you get in, because you're going to have to get equities. So people who didn't underperform going into calendar year, when the S&P dips, we're going to be looking at that 20-week moving average in volatility. And if we sell through the 10-week, how far down does it go and hit that support? Or when people start jumping ship, you come down here to 1391 on that S&P. And we'll be trading call side and put side on the S&P. So when during the earnings season, if we sell down to major support levels, we'll look at buying calls up and out of the money. If we decide to hold and we want to run back up to 1475 and we want to hold right above that 1400 level, we'll look still up and out of the money. But if we continue to sell down, we'll have to buy some puts down here that would test that 20-week moving average. What I will tell people on this S&P, with earnings season and Q4 and election, and yes, the bull run is in play. There is no doubt about that. And every bull run, if we're going to have a new bull run, we're going to have some volatility to come down and test supports. It's healthy for bull runs to come down and test that 20-week moving average and shake the people out 100 points off of the high of that S&P. Just like we shorted the S&P over here in the calendar year. And they had the shakeout before we had the bigger rallies. This is what I'm talking about, MMTs, and this is what we're going to be looking for, because the people that did not get in that whole rally there, they're on the sideline. They're going to have to put some money to work. It's going to be a very volatile week. The S&P is going to be gapping up in some mornings and gapping down based on some of the bellwether earnings and some of the stocks that trade in that S&P 500. They're all going to be coming up. Some will come up this week, and then the following week, we start getting into the bulk of the S&P 500 earnings, and the week after. Welcome aboard. Put your seatbelt on. Know how to buy the dip. Know how to work the S&P 500 and the leading companies in the S&P 500. This is the first time as of this weekly, and I said we were going to come down, and we tested the 10-week, and we did. And we were up here, and look at the weekly distribution bar here compared to the last up week. See the body of it? It's much greater in value. Do you see here that when you have reversals, you take a look at the last two up weeks of the body of the price of these weeklies, and then you take a look at the distribution cycle. If we get another weekly distribution, this weekly distribution is as equal as that last up move. A secondary week with earnings volatility to bring it down to the 20-week moving average would give us a double weekly reversal to support. At the time that the companies, the bellwethers in the S&P 500 index, the ones that miss their earnings that are quality leadership in their sectors, will be bought on the dips for calendar year end trade. Yes, there is going to be a Romney trade. Yes, there is going to be an Obama trade. Yes, there will be support levels within a rip-roaring. The way that it reads mathematically is a rip-roaring bull is in play. And just like over here at the bottoms, when the bear in 2011 was down here at the bottom, we rallied up here. The bear was all in down here. And the bear got walked all the way up to calendar 2012 highs. We traded all the way up there, and then it had that big reversal here. Now, what we're looking for in a bull run is where we could come down and test where these major breakouts happened on the S&P, use that earnings volatility and market manipulation to square into leading positions using the options on equities and indexes, and then getting net long for that next bull. And as we come down and test it, it's going to tell us exactly where that money on the sideline is waiting to get in this bull that they didn't get in. They didn't. In the summertime, we called where we got the bottom. We called the bottom. We went straight up. And we've called every single move in here. And it's a 3-week distribution. That's a lighter week. That's a fairly decent week. Here's a bigger week, though. Out of the last, when you take a look at the last 4 weeks, 20 trading days, you've got 3 to 1 on the distribution side to the 10-week support level. Now, granted, when I said the S&P was flaming overbought and that it did have to come back and we would hit that 1475 area, and we did, and we have all the analysis. We got up here to 92.83%, and we were overbought on that run on a weekly level. And the high-frequency trading algorithmatics that are in the exchange model decided to take some, decided to cross the tape and sell it down here to support level, MMT. So our worldwide, we have people who trade index options on this S&P. Both the call side make big money. Put side, they make money too. So right now the puts on the S&P are paying, and earnings volatility is going to be there. We will look at how to buy the dips in any volatility whatsoever within the beginning phase of this bull trend. Every bull starts out as one, and when they pull back, if they're strong, they're going to set up and then go higher. And we know that our next target on the S&P is 1525. That's going to be the near-term target. And we have different targets for 2013. You'll have to stay tuned for it. But are we as overbought now? No, we're not. But it's still 82%. So what I'm going to tell all of my traders is that we will buy at these support levels, and that here's that 20-week. Now, when we open up tomorrow morning going into the calendar heavily weighted week of earnings, is when you sell below a 10-week moving average that is rising and crossed over this 20-week for this bull, that's wonderful. But we are in a territory of where this S&P is getting a closing level or an intraday level below that 10-week. That's the blue line. See, 10-week MMT, worldwide traders. Look at it. The low on the S&P hit my target on a weekly level, 1425. And if you go to stockmarketfunding.com site, you'll know I said that was going to be that first area of support off of that 1475 resistance. And that was a 50 handle reversal. Yeah. I did tell you to help you. Now I'm telling you that until we close above that 10-week moving average, this thing is slightly right here in this weekly bar. And I can tell you that this is the weekly breakout bar. And when I go over here and draw a trend line, MMT, I'm going to do it for you right here. There's 1415. 1416 area. It's always right here. And this is that major bar coming down in this major support level on the S&P 500. I'm going to conclude the S&P 500. I'm going to conclude that the S&P 500 will pull back into a bull support level when it hits weekly moving averages down here, and we're going to look to see if the S&P can hold this level right here at this lower, that's 1396 before you get to the 20 week. Now, once you start to sell below the 10 week, that's where people want to get off board and they start to sell down. That's how you get to these support levels, when people start panicking and they start selling, and we start getting right down here. I'm going to draw a trend line right here, and it's going to be this area, and it's going to be 1402 on that S&P right here. So below the 10 week, there can be an exasperation of selling with bad economic reports, meaning fundamentals and stock companies. They drop the futures down, they sell it down, they wash out that bull, and then set up a new run. S&P 500 fourth quarter earnings coming up, major election, major calendar year update on 10/14 of 2012 before we even start the earnings, so that you know how to put your seatbelt on.